Good afternoon, and I'd like to thank you for standing by, and welcome to the AFS Best Practices webinar. Our topic today is navigating the new normal, how COVID-19 is impacting commercial lending. Our webinar will be approximately an hour long, and our speakers today are Don Doherty, Director, AFS Business Intelligence, and Jeremy Charlson, Senior Business Analyst, AFS Business Intelligence. We are recording today's session, and therefore this call is in listen-only mode. We do encourage questions. Please use the Q&A function and direct your questions to the presenter. We will leave some time at the end of the presentation to answer as many questions as possible. You will receive an email tomorrow with a link to listen or download the presentation. Thank you for joining us today. Don?
Thank you, Renee. Hello, everyone, and welcome to our webinar, How COVID-19 is Impacting Commercial Lending. We here at AFS sincerely hope you, your families, and your fellow co-workers are doing well in these very, very trying times. As we get started, I wanted to say that we certainly welcome any comments any of you may have on today's webinar. Our contact information is provided at the end of this presentation, so please do not hesitate to reach out to us with your questions. We would be glad to help you. It is worth noting here that the source of the data presented today is from the AFS Pricing Service. Our database is the industry source of pricing trends for commercial lending and contains over $1 trillion in commitments, with approximately 80,000 new and renewed loans being added to our database each quarter. This database is also used to prepare our monthly Pricing Trends newsletter. Again, please reach out to us if you're interested in learning more about our pricing service or if you're interested in receiving our monthly newsletter. As we move to slide 4, today we will be reviewing our pricing dashboard results through March 2020. Obviously, the situation on the ground is changing very rapidly. In April, the government launched the Paycheck Protection Program, designed to provide small business loans through SBA-approved lenders. Demand for PPP loans created unprecedented operational and technical challenges for commercial banks who had to work through frequent changes to rules and information requirements and a system outage at the SBA. Many of the banks with us today deserve a lot of credit for overcoming these challenges. By one account, banks collectively have processed 14 years worth of loan volume in 10 days. The bank's earnings presentations for the first quarter reveal just how quickly the economic and credit outlook has deteriorated. In a quarter that began much differently than it ended, loan loss provisions for the industry more than quadrupled in 1Q20. While the economic fallout from COVID-19 is comparable in scope and severity to the Great Recession, banks today are far better capitalized and far better able to weather the current situation than they were a decade ago. The most prominent story this month was the surge in commercial loan balances. Total commercial loan balances rose to unprecedented levels in March, as corporate borrowers drew heavily on lines of credit in order to stockpile cash and brace for disruptions in cash flow. Later in this presentation, Jeremy will provide a deeper analysis of line utilization across deal size and industry segments. We also saw an influx of new loans this month, specifically new participations and syndications. The Fed enacted emergency measures in March, including lowering the Fed funds rate to effectively zero. Consequently, pricing for commercial loans declined across all market segments. In terms of pricing index preferences, the volume of commercial loans tied to LIBOR was down 10% year over year, with most of the change occurring during the first quarter. And upfront fee levels for new bilateral loans increased from the prior month. According to the American Banker article on slide 5, corporate borrowers have drawn down in excess of $200 billion from existing lines of credit, resulting in a spike in first quarter loan growth. And this increase does not include the amounts lent out under the Paycheck Protection Program or the Fed's Main Street Lending Program. Many of these drawdowns came from the larger end of the market, specifically from the syndicated borrowers. According to SEC filings and other public disclosures, firms such as GM, Delta Airlines, and Marriott International all tap lines of credit to build a liquidity cushion. There is some concern, however, that certain borrowers will be unable to obtain credit. For example, leverage borrowers and energy companies are struggling to secure new or renew existing debt. Furthermore, many of these same borrowers may not meet the criteria needed to secure funds from the Fed's new lending facility. So just how big was the increase in total balances in March? In a word, the increase was unprecedented. The chart here on slide 6 from the Fed's H8 release plots annualized monthly growth rates in C&I loan balances. In the month of March alone, total C&I balances surged more than 100%. The driver of this trend was line utilization. As COVID-19 brought the economy to near standstill by the end of March, corporate borrowers drew heavily on lines of credit in order to stockpile cash and brace for supply chain disruption. The closest comparison we have to this March increase was in October 2008, shortly after the collapse of Lehman Brothers. But even during that major market disruption event, C&I loan growth did not even reach half the rate seen in March of this year. Moving to slide 7, under normal conditions, higher loan growth would be a welcome change from the subdued loan demand we experienced last year. However, banks today are not operating in a normal environment. In March, the yield on the 10-year treasuries fell to the lowest level ever, as the trend here on the left illustrates. The significance of the 10-year treasury yield is that it serves as a barometer for economic and financial conditions. When the economic outlook worsens, investors flock to safe financial instruments such as long-term treasuries, driving yields down. The decline in the 10-year treasury yield has a very real effect on commercial loan pricing, as rates on longer-term commercial loans tend to fall in lockstep with the 10-year treasury note. The economic uncertainty created by COVID-19 is reflected in the volatility index, which is presented on the right. It is a leading indicator of a dip in the S&P 500 and is one of the variables used in the Fed's annual stress test. The volatility index reached 83 in March. For comparison, the volatility index at the peak of the 2008 financial crisis hit 81. So for the month of March, we were basically at the same level of panic as we were back then. The volatility index fell to lower or better levels during April, but the most recent reading was still well above the long-term historical average. So let's see how these market dynamics played out during the first quarter. Higher volatility in the financial markets has led to higher volatility in the commercial loan market. On slide 8, starting on the top left, we present a slightly different perspective on commercial loan growth and look at year-over-year growth rates. Similar to the loan growth chart we saw a few slides back, total balances rose in March, up 11%, as companies raced to build a liquidity cushion to manage through these challenging times. While much of this growth was driven by withdrawals under existing lines of credit, we also saw an influx of new lending this month. You can see that trend in the top right graph, where new volume, the blue line, spiked higher. Moving to the bottom left, we see an expected trend given the Fed's emergency rate cuts in March, as pricing fell for both new and renewed loans. And finally, on the bottom right, we can see that as of March, upfront fee levels on bilateral loans posted very similar results to March of last year. On slide 9, The trend on the top left changes the focus from year over year and compares quarter over quarter growth rates between bilateral loans and participations in syndications. The spike in balance growth was most pronounced for participated and syndicated borrowers, up 21.2%. Moving to the top right, we look at the loan growth across deal size ranges. Focusing here on just C&I bilateral loans, balances were up across every deal size range. In previous webcasts, we have not often seen the growth in the smallest deal size range. Having said that, it was a little surprising that growth in the smaller end of the market was not higher. Perhaps the small business and lower middle market borrowers were anticipating help from the SBA and the Fed's lending programs. On the bottom left, we have a similar picture for CRE loans. Total CRE lending continued to expand at a healthy pace in 1Q. And like the C&I loans, balances were driven mainly by the larger loans. And for participations in syndications on the bottom right, loan growth surged across every size category. Much of this growth reflects large and small drawdowns from large syndicated borrowers. As we move to slide 10, we present a similar quadrant view showing differences in loan growth by state. The top left chart focuses on growth for all loan types, which includes C&I bilateral loans, CRE bilateral loans, and participations in syndications, and presents the top 5 and bottom 5 states. Pennsylvania ranked highest for total commercial loan growth in the first quarter, and with Florida and Texas, we're all up over 9%. On the top right chart, we see C&I bilateral loan growth of 3.5% at the national level, being more robust than the 2.1% national average for CRE bilateral loans, which is shown on the bottom left. For C&I, Michigan was up 10%, while CRE balances in Pennsylvania and Georgia doubled the national average. But the major loan growth story this month was the vast increase for participations in syndications. Balances were up, with many states reporting double-digit growth for the quarter. A key feature of our pricing dashboard is its granularity and the ability to drill down below the state and view trends for specific core-based statistical areas, or CBSAs. On slide 11, we have an example for Michigan, which, as we just saw on the preceding slide, ranked highest for C&I bilateral loan growth in the first quarter. Among Michigan's largest CBSAs, Kalamazoo ranked highest for loan growth during the quarter, followed by Detroit, which is the largest metro in the state in terms of commercial loan volume. Conversely, loan growth was relatively subdued in Flint and Grand Rapids. We tend to see a similar degree of variation within other states as well. One of the ways banks use our pricing data is to create regionalized market scorecards, which are used to inform the lending teams of current trends in commercial loan growth and pricing. Moving to slide 12, one of the leading indicators for commercial loan growth is real GDP. For the last several years, the 10 largest CBSAs in terms of real GDP significantly outpaced the rest of the country for commercial loan growth. In other words, cities with the highest levels of economic activity and growth tended to generate the highest levels of commercial loan growth. Given these truly unique times, we saw that relationship weaken a bit in the first quarter. While loan growth accelerated for the top 10 CBSAs, growth during the quarter was also robust for the rest of the country. Many states and even some rural markets reported sharp increases in commercial loans as borrowers raced to secure much needed liquidity. It will be interesting to see in the coming months if the rest of the country catches up to the growth rate of the top 10 CBSAs. This is something that we will be watching and reporting on in our upcoming webcasts. As we move to slide 13, we often see a strong correlation between loan growth and particular industry sectors. The manufacturing sector led total balance growth in the first quarter. This sector had struggled last year due to the trade war and other headwinds, and now manufacturing borrowers face added pressures in the form of supply chain disruptions caused by COVID-19. For many manufacturing companies, the increase in loan growth likely reflects a need for liquidity. For C&I bilateral loans on the bottom left, the manufacturing sector, encompassing wood and chemical products, ranked highest for loan growth in the first quarter. The chemical manufacturing subsector focused on resin, synthetic rubber, and artificial synthetic fibers, and the plastics and rubber products manufacturing subsector contributed to these higher balances. With the elevated need for personal protective equipment, it is not surprising to see this sector with the highest balances in 1Q20. For participations on the bottom right, retail trade led the growth during the quarter. Specifically, we observed large increases for clothing stores and also for grocery stores, where much needed cash helped to restock store shelves. Another example of the pricing dashboard's granularity is illustrated on slide 14. Here we focus on the healthcare sector and drill into the 6-digit NAICS segments that comprise the hospital's subsector to identify where the largest balance growth took place. We can see that loan growth for hospitals in the first quarter was about twice the overall healthcare average. At the 6-digit NAICS level, loan growth was highest for specialty hospitals at 8.6% and general medical and surgical hospitals at 6.1%. Next, on slide 15, we turn our attention to trends in new and renewed volume. Increased line utilization. New originations were another driver.
Don, we're having an issue with your audio. Jeremy, are you on the line?
I am, Renee. I'm going to text him real quick and.
Okay, because I was going to say maybe you'll need to pick up for him.
Sure.
Do you want, oh, I don't have his number.
I'll text him real quick. One moment.
All right. Please hold the line, everyone, while we see if we can get Don back. If not, Jeremy will continue. Thank you, and sorry for the interruption. We are having bad weather here on the East Coast where we are. Don?
I'm here. Can you hear me, Renee?
We can hear you now. Yep.
Okay. I'm on slide 16, which is focused on CRE. Okay. In contrast to the trend for C&I loans, new and renewed CRE volume was relatively flat during the first quarter, as shown here on slide 16. In their recent earnings presentations, several banks expressed a cautious tone about their commercial real estate portfolios. There is some concern that property types such as hotels and real retail shops will continue to struggle even after stay-at-home orders begin to ease. Some analysts think we may see an increase in CRE lending as these borrowers might seek new credit lines to help them stay afloat. Mirroring the trends in the broader market and policy rates, the chart on the right shows pricing for new and renewed CRE loans was down in March when compared to the prior month. On slide 17, we see one of the trends that we monitor on a regular basis, that is the volume mix of new and renewed loans by pricing index. For years, LIBOR has been the dominant pricing index for commercial loans. While this is true through the first quarter, we are beginning to see a shift away from LIBOR. On the left, we see the distribution of bilateral volume by the interest rate indices. LIBOR represented 59% of the total volume in 1Q20, which is down 6% from the last quarter and 10% from a year ago. There are two market forces driving this trend. The first is the eventual phasing out of LIBOR. Prime appears to be a reasonable substitute for new lending, at least until SOFR gains wider adoption in the market. The second is the Fed's decision to lower its policy rate to effectively zero. When rates fall, some customers try to lock into low fixed rates. You can see that the percentage of bilateral loans priced with fixed rate increased year over year. And looking at the chart on the right, we can see that LIBOR rate commercial loan volume declined year over year across every loan size range. Worth noting is that the prime rate, which previously represented a relatively small amount of the volume in the over $10 million range, now comprises nearly a quarter of that volume. Next, on slide 18, we finish our focus on new and renewed loans with a look at participations and syndications. Earlier, we saw higher total participated and syndicated balances being attributed to borrowers withdrawing large amounts under revolving lines of credit. Amplifying this trend was a surge in new participated and syndicated originations. In fact, March more than tripled the February balance. The blue line on the left shows this trend. Interestingly, the weighted average interest rate for new participations and syndications experienced the largest month-over-month decline seen over the last year. You can see the sharp decrease in the blue line on the right-hand chart. One explanation for this decrease is that the issuance of new syndicated credit was to high-quality investment-grade borrowers, which received lower interest rates than the average borrower. In fact, a couple of banks alluded to this in their recent earnings presentations. Slide 19 will conclude our market review with the summary of fee metrics. Fee trends were mixed in March. Starting at the top left, we can see that the upfront fee incidence, which is a measure of how frequently fees are assessed, fell month over month for new bilateral loans, but increased slightly for renewals. On the top right, we show the fee level, which represents the average size of the fee assessed. The upfront fee level for new bilateral loans increased in March from February, while the upfront fee level for renewed bilateral loans held steady. An industry sector that stands out in terms of fees is healthcare. As shown by the pair of charts on the bottom, this industry ranked highest in terms of both upfront fee incidence and fee level. And now we will transition into our special topic for today. Jeremy Charlson will provide an analysis focused on line of credit utilization across deal sizes and industry segments. And with that, I'll turn it over to Jeremy.
All right, great. Thank you very much, Don. And Renee, just a quick sound check. Am I still coming through okay?
Yeah, you sound good. There was a little feedback there, but I don't know if it was just you starting to talk, but you sound good.
Okay, how about now? Is that clear now?
Yep, sounds good.
All right, great. Thank you.
Yep.
And for those following along on paper, I'll be sure to note what slide I'm on. So currently we're going to be on slide 21. So I think the word that Don used to describe the commercial loan market this month was unprecedented. And in particular, it was the loan growth we saw that was truly remarkable, that over 100% increase on an annualized basis. March was perhaps the most volatile and consequential month that we've analyzed since starting the webinar series. The economy was brought to a near standstill by the end of March, creating a liquidity crisis for many companies. Consequently, commercial borrowers drew heavily on existing lines of credit to stockpile cash and brace for disruptions in both cash flow and supply chain disruptions as well. So this section of the webinar will focus on commercial line of credit utilization and its drivers. Prior to March, line of credit utilization for corporate borrowers averaged about 36%. You can see that here on slide 21. The trend was pretty steady over time. In fact, we actually omitted this chart from previous webcasts because it so rarely ever oscillated. It was holding very steady around that 36% level over time. But then everything changed in March. COVID-19 began to spread rapidly, and governors in most states issued stay-at-home orders. Government support and lending programs, such as the Paycheck Protection Program, did not begin until April, leaving businesses in March with few alternatives for liquidity outside of existing credit lines. As the chart here illustrates, revolving line of credit utilization for commercial borrowers jumped from 37% in February all the way to 46% in March. So that's a very dramatic increase and probably the largest that we've seen since reporting this data. It's that increase that helps explain why we saw a surge in overall balances earlier in the presentation. So now moving to slide 22, we have a utilization breakout by bank. Now, while some sectors and regions of the economy were hit harder than others by COVID-19, every bank in the benchmarking consortium reported a spike in line utilization in March. So the way you read this graph, the tails capture the dispersion between the min and max bank in terms of line utilization. Prior to March, the median utilization rate, as well as the overall bank dispersion, was pretty stable period to period. Then in March, the distribution and utilization rates shifted significantly upwards. Now, there was some expectation that, say, the restaurant and services industries would draw down on existing lines, but clearly the trend is permeating other sectors of the economy as well for the bank distribution to shift up so dramatically. Now, we start to see more variability in utilization rates when we segment the trend by loan type and loan size, as we do here on slide 23. Much of the increase in line utilization and total commercial loan balances was driven by participated and syndicated borrowers. So you can see the dramatic spike for this segment of the market by the green line on this particular graphic. In the public record, and as Don noted a little bit earlier, we've read about several high-profile withdrawals in the syndicated space, namely companies like GM, Kraft, and Delta Airlines, all tapped lines of credit to build a liquidity cushion in March. But middle market companies are also following this trend. As you can see by the orange series here, line utilization for bilateral loans also displayed a meaningful increase, especially when compared to the modest month-to-month changes plotted before March. The trend line in line utilization is a bit more surprising when broken out by deal size range, as we do so here on slide 24. Since smaller borrowers have limited access to capital markets and fewer sources of liquidity than their larger counterparts, we initially thought that the smaller borrowers would be more apt to draw down on their lines than the larger peers. Instead, increases in revolving line of credit utilization were most pronounced for the larger borrowers in the commercial lending space. Now, some context here is helpful. According to a recent Barlow survey, twice as many small businesses were closed due to COVID-19 than middle market companies. Additionally, this same survey revealed that small businesses typically had fewer financial levers, such as freezing raises and bonuses, to offset declining revenues. As a result, some small businesses may have been reluctant to take out any additional credit, especially when government support, such as the Paycheck Protection Program, was on the horizon for April. Now, I had mentioned earlier some of the big name companies that have tapped lines of credit recently. And here we list a few of the companies with larger withdrawals. So we're on slide 25 with a table of large withdrawals by company. So on this table, GM, for example, drew down $16 billion, not million, but $16 billion in March from one of its credit facilities. Recall from earlier that total loan growth in March had reached over 100% on an annualized basis. So with drawdowns of this magnitude, you can see how balances were able to climb so rapidly in March. The colored circles next to each company name denote the industry classification. Several names have a light blue circle, which represents the consumer discretionary industry. Obviously, this was a sector quickly and heavily impacted by COVID-19 shutdowns, as only life-sustaining businesses remained open in most states. Now here on slide 26, we have an excerpt from a Bloomberg article describing the state of the hospitals industry. And healthcare is a really interesting sector in the context of line utilization. Now, obviously right now, hospitals are as busy as ever treating patients infected with COVID-19. However, by diverting so many resources to fighting the virus, many hospitals have been left in a weaker financial position. According to Bloomberg News, hospitals are facing higher costs due to spending on equipment like masks, ventilators, and medication, while at the same time revenue is falling because all but the most essential operations are postponed. Even not-for-profit hospitals, which typically rely less on lines of credit versus their for-profit counterparts, are looking to secure lines of credit from banks to avoid liquidating other investments. So everything going on right now to fight this virus is having a very real effect, a very tangible effect on line utilization. We can see how these industry dynamics are playing out here on slide 27. The industries here are based on the GICS taxonomy, which is used in the equities market a lot. Line utilization spiked quarter over quarter for every major industry sector. Earlier, we had looked at large drawdowns for specific companies, many of whom were concentrated in the consumer discretionary sector. Not surprisingly, this industry displayed the largest increase in revolving line of credit utilization. Healthcare, which is pictured in the middle of the graph, also exhibited a significant increase in line utilization, as hospitals in particular raced to secure additional borrowing from banks. Now, the advent of COVID-19 has exacerbated another major market event, the collapse in crude oil prices. And here we have an article focused specifically on the oil and gas industry and a potential bailout of the sector. For the energy sector, the fallout from the coronavirus and its impact on the general economy really could not have come at a worse time. Earlier in March, Russia and Saudi Arabia failed to agree on production cuts to put a floor under prices. The Saudis then declared a massive production increase, matched soon after by Moscow. Predictably, oil prices tumbled. In normal times, low oil prices are a net positive for the general economy, as there's usually enough consumer demand to soak up at least some of the excess oil. Problem is, the coronavirus has shuttered businesses and eliminated all but the most essential travel plans. President Trump recently promised a rescue plan, but the details haven't been firmed up yet. According to some reports, oil and gas borrowers have been discriminated against in the Fed programs designed to purchase corporate bonds. One of the provisions to qualify in the Fed's bond buying program is to have an investment grade rating, and bonds for many oilfield services companies in particular have been downgraded below investment grade following the recent collapse in oil prices. There's even now talk of a term called proration, or maybe proration depending on how you pronounce it, which means government imposed production limits to prop up oil prices. That hasn't been done, I believe, since the 1970s. The fact that energy agencies are even considering this type of intervention speaks to the frail state of the oil and gas sector. Now here on slide 29, we can see the recent and unprecedented collapse in oil prices. In April, West Texas Intermediate crude futures traded with a negative price. This is the first time in history, the only time in history, that the benchmark fell below zero. In practical terms, a negative price means that producers have to pay traders to hold oil. To say that energy companies are struggling right now in this price environment would be a massive understatement. Now, in the context of our utilization analysis, low oil prices correlate very strongly with line utilization for oil and gas borrowers. We can see an example of that specifically for energy service borrowers here on slide 30. The chart here is designed to measure the price point below which oilfield service companies begin to tap lines of credit to help cover operating expenses. Each circle on this graph is a quarter of data. On the x-axis, we plot the WTI spot price. And on the y, we plot the average line of credit utilization rate. We drew a dividing line at $75 a barrel, which helps reveal two clusters of circles. What we notice is that utilization rates are significantly higher for the group on the left, when the price of oil is below $75 a barrel. In other words, when the price of oil is below this level, oilfield service companies draw down heavily on their lines of credit. This implies that the break-even price for oilfield service companies might be much higher than what's generally presumed to be $50 a barrel. So in most ways, March was a highly unusual month, both for the oil and gas sector and for the broader C&I loan market. Total commercial balances spiked in March as corporate borrowers drew heavily under existing lines of credit. The increase in line utilization was comparable to what we saw during the last major market disruption event more than a decade ago, when Lehman Brothers failed. The difference is that banks now are much better capitalized and much more capable of weathering the current crisis compared with the last recession. Now that the government has stepped in to increase the flow of credit to small and mid-sized customers, growth in corporate borrowing, excluding loans made as part of the Paycheck Protection Program, might be relatively subdued in April. Early indications are that while PPP volumes surged in April, traditional bank lending has fallen sharply. Some sectors, such as oil and gas, might be cut out entirely from both traditional bank lending and government support. Energy firms rated below investment grade will likely struggle to obtain new or expanded credit, especially if banks use spring borrowing-based discussions to limit credit exposure to energy borrowers. And last but not least, we want to reiterate our support for banks during these times. Our AFS Level 3 and AFS Vision teams are working diligently to help banks to fund and book PPP loans, and our business intelligence team has been publishing frequent market insights on topics such as line utilization and customer index preferences. So if you have any needs or questions, we are here for you. Please feel free to reach out to us if there's anything that we can do. And I think with that, we'll check if there's any questions on the panel here. I'm going to stop sharing for one moment and check the Q&A. So at the moment, we don't have any questions. I'm just going to go back to the PowerPoint for one moment here. Our contact information is listed at the end of this presentation. And again, Don and I want to reiterate, if there's anything that we can do for you in terms of helping answer any questions about line utilization, which industries are growing, any technical questions in terms of how to use our systems to book PPP loans, again, we're here for you. Please feel free to reach out to us. So
Jeremy, if you could sorry, I was just going to say quickly, if you could just advance to the next slide for our other upcoming webinars. So if you are interested and want to participate, please visit our website. The link will be a hot link in the presentation that you either already have or will download, and feel free to register for any of these. And as I mentioned, we will be sending an email tomorrow with a link so that you can listen to this webinar again or share it with colleagues. And with that, oh, wait, Jeremy, we have a couple questions here.
Sure.
Oh, okay. Well, one was great presentation, and the other one was about April data.
Do you have any April data to share yet? We're currently processing that. Early indications are that loan growth is definitely slowing outside of the PPP program, but as soon as we have an update on April data, we will be sure to put out a market release.
Okay, then with that, I think we are good to go. We thank you for joining us today, and everybody stay safe and stay healthy. Thank you.
Thanks, Renee.
Thank you, Don.